Hi, I'm Hilary Hendershott. One way I see investors trying to avoid or minimize the cost of hiring a financial advisor is by building so called set it and forget it portfolios. This typically means you'd be buying anywhere between 1 and 5 index funds and just holding them forever. If you're buying actively managed funds, be careful. You could be paying so much in fees that you're actually paying the same as you would if you hired an advisor. But that's a different video. Getting back to our set it and forget it investment idea, admittedly, on the surface, it sounds appealing. It's simple, it's hands off, it can be stress free. And buy and hold is typically good advice. I'm a fan of buying and holding a smartly built and managed portfolio for the long haul. When it comes to building long term wealth in taxable accounts, a set it and forget it portfolio can quietly create risks and tax drag that most investors never see coming. Today, I want to walk you through the hidden tax risks built into these portfolios, not to scare you, but to help you understand when and where thoughtful oversight actually matters. Because simplicity is only helpful if it's not costing you more than you can afford. There's a reason this approach is so popular. It appeals to something very human. We want lower fees. We want fewer decisions. We want less noise. And we want to trust that things are handled. And reducing emotional decision making is healthy. The problem is set it and forget it portfolios are designed for averages, not real people with changing tax circumstances, evolving income, or growing complexity. What starts as simplicity can quietly turn into financial autopilot, and autopilot does not adapt, especially when you're coming in for your landing. Here's where the real risk begins. Most set it and forget it portfolios are built around broad market exposure, periodic rebalancing, maybe, and long holding periods. What they're not designed to do is actively manage when and how taxes show up. Over time, that can mean gains being realized without intention, which means paying unnecessary taxes. Tax losses passing you by and going unused, which again means you paying unnecessary taxes, and capital gains distributions arriving when you least expect them. Maybe none of these events feels dramatic on their own, but together they create something really destructive, steady tax drag. And tax drag compounds quietly year after year. But unlike return compounding that works in your favor, tax drag steadily erodes your wealth. And at today's tax rates, it erodes your wealth quickly. Let's imagine an investor who saves $10,000 a year for 40 years. To keep things simple, she's investing 100% in stocks that rise 8% per year. So heading into retirement, she has $2.8 million. Set it and forget it seems like it worked pretty well. But what happens next? First, 100% of her wealth invested in stocks is no longer appropriate. So she switches to a traditional 60-40 stock bond portfolio. Well, after 40 years, over 85% of her wealth is in investment gains. So when she makes that transition to 60-40, boom, she gets a $200,000 tax bill. Except it's more like $340,000 if she lives in California. Suddenly, her $2.8 million portfolio is less than 2.6. But she's retired and ready to enjoy her savings. As she sells some investments to pay for a dream trip around the world, which is, of course, how you pay for things in retirement, that triggers tens of thousands of dollars of additional capital gains taxes, further eroding her nest egg. Set it and forget it may have got her wealthy, but it isn't helping keep her wealthy. In the early stages of building wealth, taxes feel manageable. They often are. But as portfolios grow, income rises, and as more assets live in taxable accounts, taxes become one of the largest controllable costs in an investment plan. Furthermore, set it and forget it portfolios don't ask, what tax bracket are you in now? What might that tax bracket be later? Are you approaching a taxable liquidity event? What is the taxable basis of your portfolio and what's it costing you to forego rebalancing to avoid tax bills? Do you expect changes in income, career, or in spending needs? Set it and forget it portfolios assume stability. They kind of require stability. But over the long haul, real life just doesn't cooperate with that. Tax aware investing isn't complex for its own sake. Tax aware investing means understanding the tax impact of decisions before they're made, being intentional about taking gains and losses, and for the right investors, using sophisticated strategies to amass tax losses that cancel out gains. Also, coordinating your investment strategy over all of your assets and over your entire investing life. In other words, it's not necessarily about doing more, it's about doing things on purpose. A portfolio can still be disciplined and long term focused while adapting intelligently to taxes along the way. So the real question shouldn't be, is my portfolio cheap and simple? The real question should be, is my money set up to maximize my long term wealth? And more importantly, my long term happiness? If you're thinking about your next financial chapter and want a partner who looks at the full picture, not just your investments, we'd love to connect. We're a fee only fiduciary team focused on after tax outcomes and long term planning, helping our clients keep more of what they earn so their money can support the life they're building. If that sounds like the kind of guidance you're looking for, you can schedule a complimentary conversation with one of my lead advisors by visiting hendershottwealth.com/contact to see if our approach is the right fit for you.